And then finally, our featured guest today, I'm super excited to have her on the call. Tracie is a personal friend of mine, but she's also a professional colleague. I have closed a number of loans with Tracie, both for clients who are buying properties as well as my own. I have probably closed 4 or 5 of my own loans with Tracie. So I don't just recommend her to clients. I actually use her myself. She and her team are a pleasure to work with. And the key there, I think, is sometimes everything goes smoothly, and that's great. But it's when everything goes wrong, that's when you want to know you have a trusted, capable professional on the other end of that phone. And that's what I love about Tracie and her team. Tracie, are you able to unmute yourself and say hello?
I am. Hey guys, thank you, Jeff. That's very sweet. Yeah, I mean, we do try to be as professional as possible, and you're not going to have a perfect transaction every single time, but I think it is important that you don't have a lender that runs away from the problem. You've got to just attack it and deal with it. And that is what we try to do. And they're uncomfortable conversations sometimes, but it is what it is, and we have to handle it and figure it out. So thank you.
Absolutely. So at this point, I'm going to go through the quick Q&A sort of format, and then Tracie, I'm going to attempt to make you the host, and hopefully that will work, and I will basically hand it off to you. So in terms of talking to Tracie, asking mortgage questions, since there are many of us on the call, we can't all unmute ourselves at the same time. So use the raise hand button, or if you have to, you can use the chat feature. Doug and I will kind of look out for your questions and funnel them to Tracie. When one of us calls on you, you can unmute yourself, ask your question. We'll talk about it, go back and forth or whatever. And then once we've resolved it, go back on mute and we'll move on to the next person. So pretty simple. We just have to keep ourselves on mute. Otherwise, it becomes a feedback loop. So with that, Tracie, I'm going to stop sharing my screen and see if we can move it over to you. Tracie Mayo is now the host.
Okay, so let's share this screen over here. So hold on for just a minute. Okay, can you see the Savvy Mortgage Lending logo?
Sure can. And I'm going to mute myself now and hand it over to you, Tracie. Thank you.
Okay, you're very welcome. Okay, so basically Savvy Mortgage Lending, it's my company. My spouse and I own the company. We started the company in 2016. And we did that for a couple of reasons. Number one, who doesn't like to be in business for themselves? But number two, because we saw some issues with processing, we saw issues with lending, with other lenders that we had worked with, and we decided we wanted to try to, nip that in the bud and actually start taking control of some things. So we started Savvy Mortgage Lending. I am a licensed mortgage broker. I'm also a certified mortgage planning specialist. And what that means is that I have to take additional training every year to be certified. And what I do is I work with people to make a plan for mortgages. So, getting a mortgage is not always your best option. Sometimes it is, sometimes it's not. In investment properties, it tends to be a really good way to do that. I just admitted somebody into the waiting room, or from the waiting room, Jeff, just so you know, because for some reason I had access to that. So that's what we do. We try to plan investments with people. So our goal is to always find the best rate and the best product options, and it's not always going to be the lowest rate. And so we have to look at those options and see what have we got. And from an investment standpoint, when investors are looking at rates, your rates are going to be slightly higher. So you have to look at what's that rate going to cost me, and is my money going to work on when you're running your numbers to make sure that when you buy the investment property, you're going to have some profit there. So that's kind of what we do. I've been in the mortgage industry since the beginning of 2013. I kind of came in the middle of a refi boom after I left 21 years of government service. I hated my job and I just needed to leave. I was literally about to go postal. And so I left, got into the mortgage industry and fell in love with it, because one of the things that I really like to do is educate people. And so I want to have conversations. I want to make sure that you understand the mortgage process. So that's what I do from a client standpoint. And from an investor standpoint, I want you guys to understand why rates are higher and those kinds of things. So we did move from South Carolina about 6 years ago. We started the business, like I said, about almost 5 years ago now. So we weren't here long before we just delved in. And if anybody follows me on Facebook, I put this out there because I do tend to get a little bit dark and a little bit crazy. So ignore me, but be a little bit afraid because a little bit of it's true. So I do post a lot of dark stuff. But anyway, I think that we need to all laugh a little bit more. The key factors, and I know most of you guys know this, but the key factors to getting approved for a mortgage are credit scores, income, and assets. We've got to look at those things. We've got to make sure that the income and the items on the credit report are going to work from a debt to income standpoint. And so we really, really work as a team to get you guys approved when we're doing that. So when you're buying an investment property, we can help use the market rent to help you guys qualify or to help your clients qualify. Unfortunately, the downside to buying multi-unit properties is that it does require a little bit more money down, but we can usually work around that, and people are usually prepared for that. It's a lot better to borrow the money than to have to pay cash for the property. So, that's kind of the way that everybody looks at it. But, rates are really good right now. They're actually anticipated to be going up at the end of the second quarter is what we're being told in our world, which is where we monitor rates every single day. And so they dropped really low. I had rates as low as 1.99%, in October. It's crazy how low rates were for primary homes. But, they're starting to kind of creep back up, and we do foresee them being closer to 3.25%, 3.5% before the end of the year. That's what they're anticipating. So just kind of be prepared for this increase. But that's basically what I wanted to tell you in my little, screen share. But I know Jeff's got questions for me, and I know you guys have questions for me. So throw them at me. Let's talk. You want me to stop sharing?
No, you can leave your contact info up. I'll kick it off with a softball, Tracie. For some of our newer investors, can you explain the difference between a mortgage broker and a mortgage lender? And I was going to ask about the mortgage planning specialist, but you already covered that part. But the sort of the advantages to working with a broker versus going to your local bank.
Yeah, I mean, brokers have options. I mean, that's what it comes down to. Brokers have a lot of options. Banks have one option. They've got their option, and you've got rates that they've got. And banks tend to come with what they call retail rates. So the rates tend to be a little bit higher, but they also have some limits to them because they are federally, what's the word I'm looking for? Anyway, they're monitored by certain regulations that our wholesale lenders don't necessarily have to abide by. They do have to abide by Fannie Mae and Freddie Mac, but sometimes banks just have these tighter regulations. But the biggest difference is the retail rate versus the wholesale rate that mortgage brokers get with our wholesale lenders, and the options is the best way for me to explain it.
So in layman's terms, it would be kind of like going to an insurance agent who's looking at multiple carriers and can shop around for the best rate, best policy, best coverage. You can kind of do the same thing for mortgages. Do you want the Cadillac or do you want the lowest possible rate? Or you might find a product that fits a particular type of lender or a particular type of property. You have multiple lenders or lending organizations to choose from, as opposed to just the one cookie cutter overlay at your local bank.
Yeah, and the insurance broker is probably your best way to explain that, because if you go to Allstate, you're getting Allstate. That's all you get. If you go to a mortgage broker, you're going to get all of these different options, these different carriers. They can shop it around. They can find a carrier that might provide insurance for a property that you might not be able to get insurance for otherwise. And it's the same thing with us. I mean, we've got bank statement options, we've got investor type deals. So we definitely do shop it around. And we've got about 15 different lenders that we're actually always shopping deals with. I don't look at every lender for every transaction, because if I've got a vanilla type buyer, I'm not going to need to go to certain lenders. I'm going to go to my top 3, but it does give us those options. So yes. And then what other questions did you want me to answer? Does anybody want to raise their hand and ask questions? I don't know how to tell if anybody's raising their hand though. You're muted, Jeff. You're muted.
Sorry about that. I was just saying, if you have a question and you have your hand raised and we're not calling on you, please just unmute yourself and go ahead and ask it.
Yeah.
I'm trying to look for raised hands, but I can't see everybody all at once. Todd, go ahead.
Yeah, how's it going? I really appreciate you coming and sharing this information with us. It's definitely helpful. So I think a lot of real estate investors like myself, we have kind of a problem with bankable income, maybe you'll say. I don't have a W-2 job. And so if I could just run through kind of a scenario that I'm thinking about, I just want to see what's possible. So if I wanted to do a BRRRR investment of a single family home, say $100,000, I buy in cash, and then I want to come to you for a cash out refinance, and you look at my income, and my income right now, I have a 5-unit property. And so last year, I was in the process of remodeling. It didn't make a lot of money off it. I think I netted 17,000. But I have a lot of reserves, but that 17,000 doesn't look so good when it comes to income. Would you be able to do a cash out refinance based on reserves that I have, or what would that look like?
Well, that answer is going to always be, it depends. But I would tell you, we've got options for people who don't really show qualifying income. They're going to be bank statement options. You're going to have to be self-employed for at least 2 years, or at least have some, this investment type business for 2 years or more in most cases. And then what we can do is we can look at your bank statements. We can look at this money coming in. We cannot really qualify you on reserves normally. We can, if it's retirement or employment income that's sitting there in assets, we can sometimes qualify you that way. But that's a really big, it depends answer. Honestly, Todd, it's really hard to tell you for sure on that. I would have to see the entire picture to be able to tell you. I mean, 17,000, you're right, from a taxable income standpoint is not a lot of income to show. But if we can show those bank statements and show this money coming in, we don't have to look at your tax returns at all. Okay. And so we can kind of qualify you that way. But it's kind of one of those, we would have to really talk about what we're looking at.
Mm-hmm. Just a follow-up question on that. With the 2 years, exactly. So I just started this LLC for this 5-plex that I just bought. So that was about 1 year and 2 months ago. But before that, I mean, I made money off of investments, mostly off of stocks. Would that, even though, like, if I consider myself an investor as being self-employed, would that count as that 2 years, or is it only the 2 years of the LLC with this 5-plex?
Well, that's another it depends answer, but technically what we can argue with underwriting, and that's really my job, is to argue on a regular basis with underwriters because I do it a lot. But we can show the underwriter, if we can show the underwriter, that there is a correlation between the business that you had as a sole proprietor type of, investment business and converting it over to LLC from a tax strategy standpoint, then we could possibly tie those two together. But I'll be honest with you, not many underwriters go for that. We have had it work, and it depends on the underwriter, because what you guys have to remember about underwriting is there is no such thing as common sense underwriting in today's mortgage world. There used to be, there's not anymore, but you do get some common sense underwriters that will say, okay, I see what you're saying. and they will sometimes agree to approve it because it's really based on their position. And if they can, if we can articulate it in such a way that it makes sense to them and we can document the file, that's all they really care about is documenting the file. So it is possible, but to be quite honest with you, I doubt it in your scenario because it sounded like you were doing it with like market investment, stocks and bonds or whatever. And now you've totally flipped it to, your fiveplex. So I think that would be a little bit problematic. So I think you are looking at that 2-year time frame for that.
Okay.
Yeah.
That makes sense. So it would almost be better for me to wait 2 years because also at some point I need to talk to a commercial lender and look at doing a cash out refinance of the fiveplex that I have. Right now, the fiveplex I have is all in cash, 100% equity in it. But it's the same type of thing that I might have to wait those 2 years for it to be seasoned enough for them to see what it's producing as far as net.
Yeah, and I would tell you, commercial lending is a little bit different. They may not have the same regulations and requirements that we do, so keep that in mind. They may be a little looser in that regard because, and I'm not a commercial lender at all, so you're definitely going to need to talk to your person next week. But that they do sometimes not require that 2-year time frame. So if the property carries itself and that makes sense to them, then they will sometimes lend on that. So you may be okay on that one.
Okay.
Yeah.
Okay. Thank you.
You're welcome.
And Mitch, I do see your question, and I'll get to yours next. Todd, I was just going to add that I'm self-employed, and I've done a number of closings with Tracie, and it's tough, even with an established business that exceeds that 2-year timeline. Lenders are very cautious right now with the state of the world, and so they typically ask for mountains of paperwork documenting anything and everything. But I do think on the commercial side, they want to see the property performing, and having that 1 year of financials when you were doing rehab and it was partially vacant, that's really tough to underwrite on. But if you add a year of sort of normal performance to that, where the property is cash flow and it has a reasonable debt service coverage ratio, that will give the lender a lot more comfort. And then, all the other factors that go into it in terms of assets and income and things like that will obviously weigh in. But the property's performance is going to be a big chunk of it on the commercial side.
Sure.
Mitch had a question, and this I believe pertains to a VA loan. So how long do you have to wait with the VA multifamily loan to refinance? And so from that question, I assume you buy a fourplex as a veteran, you finance it at 100%, and at what point can you or should you refinance? And Tracie, I'll let you take that one, but I think a lot of it is going to depend on the equity. And if you don't have any equity in the property because you financed it at 100%, you have to wait for the property to appreciate before you really would have any reason to refi.
Yeah, and let me, I guess, Mitch, let me ask you this question. When you say you're going to refinance it, what are you refinancing it for? Are you refinancing it to put it into a conventional type investor type loan, or are you looking to just get a better rate? What's the plan?
Hi, Tracie. Yeah, thanks. So my plan is to buy one property for the next 10 years, hopefully every year. So the idea is to refinance properties as long as, of course, the market appreciates, and then pull out the equity, use it as a down payment for the next property to get the mortgage a little lower.
Yeah, so yeah, what Jeff said is totally true. I mean, if you're going to try to refinance that property to get some money, to get the money out to go and buy a new property, you're going to have equity. And to refinance it, a multi-unit property, to take cash out, you have to maintain, in most cases, 30% equity. They'll take you up to 70% loan to value on a cash out refi of a multi-unit if you're actually going to refinance it out of your VA loan. Now, if you're just refinancing a VA loan and taking cash out, some lenders will let you go up to 100% of the value, but it really does depend on what you're really looking to do. And the property, can carry itself probably because you've got 3 other units, give or take, that you're getting rental income from. But as far as taking that equity out, that's what you're going to be limited to, is how much equity do you have to take out?
Okay, that makes sense. So it's not necessarily a time thing to where the VA loan specifies like, hey, you have to wait so many days or so many years. It's mostly a matter of appreciation and the equity that's built up in the property.
Yeah,
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 and
yeah. I'm sorry, go ahead, Jeff.
I was just going to say the challenge there, and VA loans are wonderful for veterans to acquire their primary residence, but the challenge when you purchase a property with 100% leverage is really to refinance into a conventional loan product. You can do that at 75 or 80% LTV, depending on if you're owner occupy. And so figure about 75 or 80% LTV. So you need to appreciate a lot from 100% financed to having 25% equity in the property. And so even in this market where prices are going up 15% a year, it might still take 3 or 4 years to appreciate an extra 40 or 50% or whatever it takes to get you to that 75% LTV on a cash out refi. It's a great question. And it's a number crunching strategy that a lot of veterans struggle with when they want to repeat the process.
Yeah, I
Okay,
agree.
awesome. Yeah, that makes sense. Glad I asked.
Anyone else?
Tracie,
Yeah.
Tracie, we have one here from Amy in the chat, and this was actually one of my frequently asked questions that I was going to ask you as well. She asked, have you worked with any lenders that will allow you to close via a land trust or an LLC? Or do most investors wait until after closing to switch them over to an LLC or a trust? And I believe that LLC and trust are really two different things and when you're talking about doing that. But that's probably one of the most frequently asked questions I get is, can you get a residential loan in the name of an LLC? And then part two, should individuals transfer their property into an LLC after closing? And it's a really loaded question, and it pertains to your mortgage and your due on sale clause and your insurance coverage and other factors. So can you tackle that both from an LLC perspective and from a trust perspective?
Yeah, so technically, yes, you can close, in some cases, a residential property in an LLC. It depends on the lender, and they, with lenders, everything is about risk. So when you are putting something into an LLC, they might be willing to do it, and they're not my top lenders, I'm just going to be honest with you, but they're going to add risk to it, which means your rate's going to be higher. They're going to add additional points. They might let you do it, they might not. It just depends on the lender. Whether you do it in a trust or not is a totally different animal, because you can close in a trust. I mean, people do that all the time. It has to be a particular type of trust. And it, again, depends on the lender, because there are so many different options. And that's where being with a broker helps, because we can go and find that lender that's going to let you do what you or your clients are trying to do. To tackle the part about moving it into an LLC after closing, people do it. People do it all day long. Like Jeff mentioned, you are going to have that potential due on sale clause issue that's going to come up, but I don't know that I have ever seen that happen, because lenders they're not in the business to own real estate. They don't want to pull your real estate back. They just want to make interest on their money. And as long as you're continuing to make that payment, I've never seen it be called, but that doesn't mean that it can't be. So just kind of keep that in mind. But I work with investors all the time that close in their personal name, and I know, and they've told me they are closing in an LLC. They're going to go and do, not close in an LLC, but move it over to the LLC. So I can't give you a straight answer on either one of those questions, Jeff, honestly, but it is done, and it can be done without issue.
Yeah, and the one thing I'll add to that for Amy's benefit, since she asked the question, the one pitfall in doing that is if you buy the property as Amy Bhatia and you put it in your own name and you have your insurance coverage in your own name because you own the property, and then you go down to the courthouse and you record a deed and you move it over to Bhatia LLC. Well, the problem now is Amy, the person, no longer has an insurable interest in that property because she doesn't own it anymore. And so that insurance policy that you're paying good money for is probably not going to pay out on any claims, because they're going to say, well, you don't even own the property. Why do you even have this policy? That was that was silly of you to pay these premiums for a property that you no longer own. And then the other flip side to that is, if you do change your insurance coverage, your mortgage company is a named insured on your insurance policy. And so your insurance company sends your mortgage company a notice that says, hey, Amy dropped coverage on this property. And then your mortgage company may purchase insurance on your behalf, or they may come take a closer look at your loan to find out why this happened. And so there are some checkpoints built in there for the mortgage companies. And so it's just something to keep in mind. If you do transfer it, be sure to also switch your insurance coverage. And your insurance coverage is probably going to be more expensive for a property held in an LLC. Much like mortgage underwriting, it's all about risk, and they see that as a higher risk than a person who owns it in their own name for whatever reason. But I've been there where I switched the property over, and the insurance prices were completely different.
Yeah. Yeah. And to kind of piggyback on that too, if you get to that point to where you really have created your LLC and you're really you want to start moving those properties into the LLC, it might be a good opportunity for you to start talking to that commercial lender and building that relationship with them, and maybe refinancing those properties out of your personal name into the LLC. And that way you're kind of moving into that direction. Just something to think about.
I don't see any hands up, so if I'm missing anybody, please let me know. But Tracie, I have one other comment or question I wanted to throw in. A lot of people I talk to view mortgages and mortgage brokers, mortgage lenders, the whole industry as sort of a commodity. Everybody's the same. I don't care who I get it from. I just want the best rate. And I've learned the hard way that can be a mistake, because some of these big box lenders, so to speak, are all about the high volume, and they're not about the unique situation or the non-cookie cutter borrower. And so can you speak to kind of the importance of intangibles like customer service and industry expertise, and having access to multiple types of lenders, and also things like origination costs that aren't always visible in the rate? Somebody may have a really low rate but a really high points requirement or really high origination costs, and you really have to look at the total cost of the loan product, in addition to what kind of service are you going to get out of that lender in exchange for the really cheap prices.
Yeah, I mean, well, first of all, everybody looks on the internet. It's crazy. They start seeing rates, and they think the rates are 2.5, 2.625, whatever. They come to me, they start presenting these rates, and they do think that that's where the rates are because that's what they're seeing. But what they really, and I educate people on a regular basis, you've got to look at the small print. You've got to look at those disclosures and assumptions is what it's called. And it's going to always indicate what you're actually paying to get that rate. And it's usually in the form of points. It's usually in the form of at least 1 point, sometimes 2 points. And they do have an origination fee on top of that as well. So, I mean, you're paying points plus an origination. So you definitely, the lowest rate is not always your best deal. What we look at is the lowest rate with the lowest cost. That's what we try to figure out. So, and we've got the option to go all the way down to 1.99% on an interest rate on any transaction. It's just a matter of how much do you want to pay to get that rate. So that's what we try to do. And if we have to shop it around with another lender, that's what we do. And, luckily we do have those other lenders to talk to. But yeah, I mean, I would say customer service is key for sure. I mean, you've got to work with somebody that you can reach out to, and they're not so busy that they can't take time to talk to you. If not during the day, at least in the evenings or on the weekends, or be there for you and your client when you find that perfect property that you've got to go and buy. I can promise you the banks aren't going to be there for you. They're 9 to 5, Monday through Friday. So, customer service and responsiveness is huge when you're looking to build a relationship, whether it's with us or any other person. You want to make sure that person's going to respond to you when you need them, because they're no good to you if they're not responding when you need them. And I forget what else you were asking about, Jeff. I know, yeah, I mean, I forget. You definitely don't want to work with a big box lender, I can tell you that, because you're definitely not getting your best deal that way.
Yeah, I think you covered it. And Doug, I see you have a great question. Since I know you know how to do it, I'll let you unmute yourself and ask it yourself.
All right. Basically, I work with a lot of investors, and they're looking at these properties that need renovations done to them. Conventional financing, FHA, VA, none of them will finance a house that needs a roof and plumbing and kitchen and flooring and et cetera, et cetera. The renovation loan seems to be one of those ways to be able to get around that, where you can buy the property hypothetically for 150,000 worth of renovations and it's worth 200 plus. Can you kind of walk through like how that renovation loan operates and the steps that go into that?
Yeah, so renovation loans, they're a little more complicated. There's a little more fees involved in these loans. But the way that it works is like Doug, in Doug's scenario, Doug, when you say you're going to pay 100,000 for the house, you need to put about 50,000 renovation in there. And after the renovation's done, it's going to be worth about 200. The way that the lender is going to look at that is they're going to loan up to a certain percentage of the finished value. So they're going to look at how much the value is at purchase, and then they're going to look at what the estimated value is going to be once the renovation's complete, and they're going to take you up to a certain percentage of that. So as long as you've got that equity in the property, the renovations can be rolled into the loan. I don't know how much you guys know about the process itself, but I'm going to kind of walk you through in a little snapshot of it. So that 50,000 in renovation cost would go into the escrow account, the lender's escrow account. It sits there, and you close on the loan. The renovation starts. The renovations have to be completed within a certain time frame, and depending on which loan program and which what needs to be done on the property dictates how long the lender gives you to do that. But as things are completed, there's an inspector that goes out to verify that the renovation that they're getting ready to release money for has been completed. So for example, let's say that you've got a roof that needs to be replaced, flooring needs to be replaced, and maybe a kitchen that needs to be renovated. So the roof is the first thing to get done in my scenario. They're going to send someone out. They're going to say, okay, it looks like the roof has been completed. We will sign off and release the money to the roof contractor. And then you've got the flooring guy, and he says, well, hey, I'm finished with my flooring now. I want somebody to come out and inspect mine. Same thing, they're going to go out and inspect it. They're going to sign off on it. And then the flooring guy can be paid. And they will allow up to 5 draws on these renovation loans. So, you know, once everything's complete, if there's any money left over, that money can then be applied to the principal balance for the client. They don't get that money. That money has to go to something, but it can be applied to the principal balance and buy it down. But the rates are higher with those loans. They don't close in 30 days. They normally take about 45 to 60 days, and it gets very complicated. And if you've got a buyer who doesn't have a lot of money for closing costs, it's not going to be their best option, because they are going to have some extra fees with the closing costs, because every time an inspector has to go back out there to inspect that property, there's a fee. Every time there's a draw and something needs to be, looked at, there's a fee. And there's just so many things. And the person doing the renovation has to be a licensed general contractor. It can't be the investor, perhaps, doing the renovations themselves. It does have to be approved by underwriting. So just kind of keep that in mind, but that's kind of the renovation loan in a nutshell.
Thank you.
You're welcome.
And that last point is very important. Being forced to use a GC for everything is going to drive up a lot of your costs to the tune of 20% or more. And so in the end, it can be a great way to take down a property that needs a significant investment. But like Tracie said, you're going to have a lot more costs on the origination. You're going to have a lot more closing costs. You're going to have costs associated with these inspections and the draws. You're going to have a lot of red tape and hassle associated with getting a contractor to do the work, with a promise of getting paid, once the mortgage company sends out the inspector. And then you're going to be paying, GC rates for pretty much everything. So you got to factor in a lot of buffer into the analysis of a property for that type of product.
Well, and let me add one thing, because you did just touch on something that I probably should have referenced as well. When you do a renovation loan, no money gets released up front. So if you've got a GC who says, you know what, I need $10,000 to order materials, or I need a $10,000 investment, that money's coming out of your pocket or your client's pocket up front. Now, it doesn't mean that they can't get reimbursed back for that, but the lender is not giving any money up front. It's sitting in that escrow account until they sign off on it and release it.
Tracie, can you talk a little more about credit, income, and debt to income ratios? You know, how good does my credit need to be to buy an investment property, and how much money do I need to make to buy an investment property? And then as sort of a corollary to that, and Todd touched on this earlier, how much do I need to have in cash reserves? You know, do I need tens of thousands of dollars in the bank to buy an investment property? And, you know, how good does my credit and income and debt have to be?
So your credit score only has to be 620. That's the minimum, 620. But that's the minimum, and minimum is not going to get you a great rate. It's gonna have some overlay issues, is what the lenders call them. So, you know, they're going to look at the entire picture when they're looking at a client, and we run every client through an AUS system, and that stands for automated underwriting system. So we're going to run them through AUS, and whatever the findings state on that AUS finding is going to dictate what the lender will allow. And so if they look at the whole picture and your debt to income ratio is tight, your credit score is low, and your reserves are low, they're going to deny the loan, even though you might have an eligible rate and an eligible an eligible credit score and an eligible debt to income ratio and eligible reserves. If it all doesn't look good to them, then AUS could say no. And so when you start looking at that, you really want to have, you know, again, it's all about risk with lending. And so when you have a big risk profile, they can tend to deny it. But we like to see your debt to income ratio being at 45% or less. Doesn't mean that we can't go higher. And especially if you've got great credit scores, those are considered compensating factors that lenders and underwriters will look at. Reserves are a totally different issue. So I'm going to kind of talk to you a little bit about reserves. I did pull up Fannie Mae guidelines on minimum reserves because I had a feeling you guys would ask that. So right now, first of all, pre-COVID, you had a certain number of reserves that were required. Post-COVID, they tightened up. Everything kind of tightened up in March, April, May of last year and continued to stay tight. So right now, if you've got 1 to 4 properties, Fannie Mae, Freddie Mac say all you need is about 2% of the unpaid principal balance. So it's normally something like 2 months reserves on most properties, and in some cases 6 months reserves. So it really does depend on what you're buying, how many properties you've got, and how many reserves the particular lender is going to require. Because again, Fannie Mae, Freddie Mac have their requirements, but lenders can have those overlays. So lenders can say, you know what, Fannie says 2 months, I say 3 months. And they can say, I want to see 3 months reserves for every property that you own. So when you start looking at investment properties, though, they really do want 6 months reserves in most cases. And so you've got to really be able to show that. And it's for each property that you've got financed, not each property that you own. So that's kind of what they look at. But again, those are kind of subject to different things with different lenders as well.
And Tracie, being one of those dreaded self-employed individuals, I know that the reserves can be met through like investment accounts and stock holdings and things like that. So it doesn't have to be a pile of cash sitting in a savings account. Can you clarify where the reserves can come from?
Yeah, they can definitely come in the form of 401ks. They can come in the form of a business account. They can come in the form of IRAs, stocks. I mean, they will look at certain stocks are a little bit iffy, and it really depends on the situation, but it really depends on, you know, just being able to show that you do have the means to, if you had to pull this money, you have the money to pay those bills for the next 6 months if you needed to. And you know, honestly, retirement accounts are ideal for that, because it is your money, it's sitting there, and it's truly reserves.
I don't see any other hands up, so if I'm missing anything, please let me know. And again, I want to go back to something Todd mentioned earlier about being self-employed and the fact that lenders love W-2 income. They would rather have a W-2 person that works at Publix than a self-employed individual that makes 6 figures. It's really bizarre to me as a business owner. But I know that there's also a lot of our clients who have this goal of leaving their 9-to-5 job and someday becoming a full-time, you know, real estate investor or you know, realtor or combination thereof, but kind of getting out of the rat race, so to speak, and owning a bunch of rental properties and living off the passive income. But and my question there is, you know, what would you tell somebody that's planning to do that? Because my thoughts are, you tell them, oh, don't give up that W-2 job because it's going to help you with financing. It's going to help you get there. So you certainly don't want to give it up too soon. But if that's somebody's end game, you know, how would you advise them in terms of planning when to punch out of that 9-to-5 W-2 job?
Yeah, I mean, agreed. I'm not going to tell you to ever leave a W-2 job, honestly. If you're really wanting to use that W-2 income to help you qualify. But I would probably say, as you build up your portfolio, as long as you are seeing true profit each month, not just that the properties are covering themselves, but that you're actually making income on a regular basis, that's when you can start looking at saying, you know, I'm doing pretty well. You know, I mean, I'm pulling in $10,000 a month or something, and it's paying for everything, and I've still got $3,000 left over. You know, and that's just a number that I'm throwing out there. But if you've got this money coming in and you're seeing the cash flow, then that's when you want to maybe think about doing that. If that's really your end game, definitely. You know, I think most of you on this call all are investors or have your real estate license. I mean, it definitely helps to have that business set up to where you can write off some stuff and just get creative with your financing. But people do it all the time. I mean, you know, it's just, it's easy to do once you know what you're doing, but you've just got to be prepared that you're gonna have that struggle anytime you're trying to get financing, because even like Jeff said, I mean, Jeff's an experienced, seasoned, very knowledgeable person, and he still has to go through the crap that we put him through every time he wants to do something, and you know, it's complicated.
And it gets more complicated every time because you're buying something else.
Yeah.
But I think that's a brilliant point, is run it like a business. Don't be, you know, Joe Schmo who's got, you know, not tracking and accounting for your income and expenses. You know, use QuickBooks, use a CPA, get your books in order, because that is your ticket to financial freedom. If you don't want to have that W-2 job, is treat it like a business and account for it like a business. Brent has a question about debt service loans, and Brent, I'm going to ask you to unmute and just clarify and ask that directly to Tracie.
Yes. So like I said, I'm kind of newly self-employed, and I've heard about a loan type that basically look at, like you said, the rental possibilities of that unit or multiplex that you're trying to buy, and kind of uses that as a requirement, or I guess what you need to actually get the loan if you don't have the W-2 income to qualify for it.
Yeah, so you can get debt service loans for sure. We've got 3 or 4 lenders that will actually do those. The rates are higher, but they will, as long as the property carries itself, they don't look at any other income. They look at the property. The property is what gets approved, not the investor. So you do have those options. They do come with a cost, because again, everything in lending and in stuff like this is totally risk-based. So when you're waiting on a property to carry itself and you've got nothing else to back it up, the lenders are going to add some adjusting risk to that. And that risk is going to come in the form of higher interest rates, anywhere from 5 to 12%, depending on what lender you're going with, and points. So, but there are lenders that do them all day long, and you can actually get those loans closed fairly quickly. It's almost, it's considered a non-QM product, a non-qualified mortgage product. And it's also considered kind of a private mortgage lending option, but you can totally do those. You just got to know that there's a cost to it, and you have to look at it as the cost of doing business. And you, again, I always point to, you want to make sure that your investment is going to carry itself, and or else the numbers, if they're not making sense, they may not make sense. And it doesn't mean that they have to make sense from day one, but they've got to make sense at some point where you're breaking even and making a profit on it. But you can do those loans.
Is there,
Go ahead, Brent.
but I was just saying, is there something else that I guess is a better, like if, like, so my issue is being newly self-employed, I don't have the W-2, but I might have, other investments and, multiple rental properties that have over 50% equity in them that combined, I mean, shows a pretty good credit history. I have a good credit score, all those kind of things, but without that W-2 income, that seems to be kind of the single thing that's holding me back at the moment from kind of a standard loan, I guess.
Yeah, it's a little more complicated. I'm just going to be honest with you, Brent. I mean, there are some lenders out there that will do portfolio lending where they take all of your properties and consider it a portfolio and they'll loan against it. We don't really have, I'll be honest with you, I've got a lender probably that does it, but I'm not your person for those loans. You're probably going to be better off working through a commercial lender on something like that. But yeah, it's going to be a little complicated on those because they do require more money down. They require the higher rate. They require the points, the additional cost. So what were you going to add to that, Jeff?
I was just going to talk about when a loan like that might make sense. And I can think of two scenarios. One is if you purchased a property with hard money. If you're paying 12 or 14% interest and you've got 1 year interest only and you've got to refinance, by the end of the year, going from a 14% interest only hard money note to a 6% fully amortized note can make a lot of sense. It's a middle option. It's not quite as great as a conventional mortgage product, but it beats the heck out of being stuck in maybe having to pay for an extra year of hard money. And then the other scenario I can think of is if you own the property free and clear and you've got $150,000 of your own money tied up in 100% equity in a property. In some cases, it might be better to pay 6% interest and pull out 60 or 70% of that equity and use it to go buy another property or use it for some other meaningful investment or whatever you need to do with that money. It gives you access to your equity and can free up that capital. So that's kind of two scenarios where a middle of the road loan product like that might make sense. And the only other thing I was going to mention, Tracie, is we have people of all different experience levels on the call, and we've mentioned points 5 or 6 times. Can you just explain what we mean when we're talking about points?
Yeah, sorry about that. So a point is 1% of the loan amount. And not every rate comes with a full point. It could come with a portion of a point. It could come with 1.5 points. So when they start adding points to the transaction, it's additional closing costs that you have to pay. And like I said, 1 point is 1% of the loan amount. So if you're looking at a $150,000 loan, you're looking at 1 point being $1,500. 2 points would be $3,000, and that would be over and above your normal standard closing cost. In addition to whatever other origination fee that the lender might have on there as well, like underwriting fee or admin fee. So it does start adding up, and you do see a lot of points with investor deals. It's just part of the way rates are priced right now, and if you can get, I'm gonna say this off the record, even though I know Jeff's recording this thing. Don't ever share this thing. Technically, a lot of people have bought investment properties as a second home. If they're not local and they are going to use it for short-term rentals or something like that, that's technically a legal second home. And it actually helps them to get into a much better interest rate, a much lower down payment, and they don't have to worry about those points. And they can actually put someone in there and rent it like a VRBO, Airbnb, short-term, as long as they have the ability to have access to that property at some point during a calendar year, is the way that Fannie Mae and Freddie Mac classify that. So that could be a good option for someone too. And I'm really speaking more to your clients because you guys are local. It's going to be kind of hard for you to claim something as a second home here. But technically you could do that, but that's going to come with lesser points. But yeah, I kind of went off on my little rabbit trail about that. But yeah, I mean, the points can get pricey. I'll just shut up and finish with that.
No, that was a great point. It was a great little rabbit hole. But just to clarify, points are essentially interest paid up front. So you might get a loan that offers you 3% if you're willing to pay 3 points, which means you've got to pay 3% of the loan amount at closing to get that really good interest rate.
Yeah.
Or the rate might be 4.5% if you don't pay any points at closing. And that's what Tracie mentioned earlier about you really have to weigh the total cost of the points and the interest and how that's going to impact your debt service over the life of the loan. And those costs can swing widely at closing or over the course of the loan in terms of interest based on the rate.
Well, and honestly, there are a lot of reasons you do want to pay points, to be quite honest with you, because you get that lower rate, which is going to help your monthly income coming from that property cover itself, because now you don't have this bigger rate that you're dealing with. It's covering itself. You get to write those points off on your taxes. It's upfront expense if you're writing these things off. So I mean, there are definitely times that there's nothing wrong with paying points to get that better rate.
Jordan, I see you have your hand up. You can go ahead and unmute yourself and ask your question.
Gotcha. First off, good afternoon, everyone. Happy to be here. Kind of a two-part question for you. As a mortgage broker, when you are working with a bunch of different companies to try to find the best loan, is that going to, if I were to go to you and try to get a loan, how is that going to affect my credit if multiple places are going to be pretty much running my credit to see if they can get me a loan? Is that going to hurt my credit at all? Or are they just going to run it once, twice? How exactly is that going to affect it?
Well, that's a great question because we only run it one time. Every lender that we work with takes my credit report. So I pull your credit and that's all, one credit pull. And then I'm going to shop it around with the lender using the credit report that I have because they accept my credit report. So we're not running credit multiple times. When we send it to the lender, the credit report is good itself for 90 days. So as long as we get you to closing within that 90-day time frame, there's not going to be another pull on your credit. They do recheck. They do what's called a soft pull or a recheck of your credit. It doesn't affect your score at all, but they do a double check at the end of the transaction just to make sure that you didn't go out and buy a yacht or a Mercedes or another house or something that they're not aware of. But it's not going to affect your score. When it would affect your score is if you, Jordan, were going to different lenders and having everybody pull your credit. That's when it really does start affecting your score if you have too many inquiries in a certain amount of time. But even Fannie Mae and Freddie Mac and the credit bureaus have all agreed that when you are shopping for a mortgage, as long as you're working directly with mortgage companies that are pulling your credit and you're shopping for a mortgage, they don't let your score drop if it's done within a certain time frame. And that certain time frame is usually about 2 to 3 weeks. So there's not a big risk to your credit score as long as you've got decent credit to begin with. It's not going to hurt you.
Gotcha. And then the second part to that question, something completely different, more about down payments. And I know we briefly spoke in an email chain yesterday about down payments. For small multifamily properties, 2 to 4, are your lenders having or requiring more than 20% down on properties like that, especially with COVID and things being tightened up, or is 20% still okay for a 2 to 4 unit right now?
Well, it depends on the lender because that's going to be another a factor that has to be factored in. But I will tell you that most of the lenders right now for multi-unit properties are requiring 20 to 25% down. So it just really, really depends on the situation and the lender that we go to, but most of them do on the multifamily need the 25% down right now.
Okay.
Yeah.
And then if it's okay, I'd actually like to ask a third question, if that's okay. Sorry to be taking up the the mic time here. Also on the down payment kind of realm, I know that in my email that I asked you, because I'm looking for creative ways to keep more money in my pocket when looking at properties. I understand with COVID, things being tightened up, even for a single family residence, 20% down is pretty much the industry standard right now. Very understandable. Have you worked with lenders in the past where they have required less than 20% down pre-COVID? And hopefully if things get better, when they do get better and we go back to a normal, whatever that new normal is, do you see lenders hopefully lessening that requirement so that investors can come in for single family homes with less than 20% down, say even 15%?
Yeah, and Fannie and Freddie both allow 15% down on investment single families. It's the lender overlays that have kind of changed that since COVID. So yeah, I think that you would get back to 15% down, probably toward the end of the year, to be quite honest with you, because right now lenders are still very tight and everybody's afraid of 2008 happening again, to be quite honest with you, because a lot of people went into forbearance for valid reasons. But a lot of people also went into forbearance for not valid reasons, just because they could. And what going into forbearance does is it hurts the servicers of the mortgage. So it makes servicing mortgages not appealing. And so what that means is that you've got mortgage lenders, they can't find anyone to service their mortgages, so they're servicing them themselves. And again, it adds risk to it. So everybody's a little bit afraid that when that forbearance moratorium is released, then people are going to not be able to catch up on their mortgages, or they're going to have to sell their properties, and everybody's a little bit scared. So once we see what's going to happen after all of this next 6 months takes place, I think that we'll start seeing that opening up, as long as the market doesn't crash. And I seriously doubt it's going to. But you've got your scared people on this side, and then you've got your people on this side that lived through 2008. And we know it's not going to happen again. We know. But you've got the people who do think that it could. And so I think that that's when we're going to start seeing those requirements kind of come down a little bit.
Gotcha.
Yeah, and interestingly, one of the things that caused the collapse of 2008 was people being over leveraged, people being 97% LTV and really high LTV on investment properties or owner occupied properties. And that's why we're seeing that tightening of the belt in terms of LTV. I see Doug has a question, and then Todd. So if you guys could just go ahead and do it in that order, and you can shoot your question right at Tracie.
All right. I just, I get a lot of questions from investors, and this is one of them that I hear on a regular basis. If you already have a loan on a property and later need to do renovations, like after a tenant moves out, need to replace and do carpet and whatever else, is it better to do a HELOC or a private money loan? Or is it better to try and just refinance the loan if it's been several years and it's time to refinance anyway to try and take some cash out?
Yeah, so that's going to be that it depends answer too. HELOCs, honestly, are probably always your better option because they come with less closing cost, but they come with higher rates. They're a little easier to get approved, or used to be pre-COVID. Right now, you can't really find many HELOC providers right now because, again, it comes down to we're not sure what's going to happen to the values of the property. Nobody wants to have another line of credit against a property, so they just don't want to do it right now. But it depends on what their rates are right now. If they've got a really high rate and they've got a good opportunity to refinance into a 3% rate, then it might make sense to let's do a cash out refinance and take that renovation and do it at that point. And I know plenty of investors that do that all day long. I'm working with one right now, and he's got plenty of equity in his property, and he's just going to take it out and do his renovation and put another tenant in it and probably get a higher paying tenant. So you've got that option. Private money is always an option too, because you're going to have all these different options available. It just depends on which one makes the most sense for you and what you can qualify for. Because the private money you might be able to get a little easier than doing a cash out refi. But I like the idea of a HELOC. We personally don't do standalone home equity lines of credit, which is what a HELOC is. But I like the option of a HELOC because it does give you flexibility. and you can use it and pay it back, use it, pay it back. And it's like a credit card. So it gives you some flexibility and some, you know, some money to use as you need it, when you need it. But it depends, to answer your question.
Tracie, are you seeing HELOCs made available on investment properties, or are you referring mainly to getting a HELOC on your primary?
Well, it depends. I'm not seeing HELOCs at all right now. I mean, I don't know of any lender that is doing HELOCs that I personally have worked with. And even Wells Fargo had cut it back. And I had a client that was looking for one with Wells Fargo, and they had said that they weren't doing it. But to answer your question, probably not on investment properties right now, because again, it's the risk. But if you've got the primary, then that's always a good option for you. And you said Todd had a question?
I think Todd's question was a little more personal and specific, and I can address that offline. So I will open up the floor to anybody else who has any questions.
Okay.
Well, we are just over an hour, and I'm not seeing any other hands up or any other questions. I think this was incredibly valuable. Tracie, I thank you so much for your time. And if anybody has more specific personal situational questions for Tracie, her contact info has been up there on the screen this whole time. Don't hesitate to shoot her an email, call or text. I know she or her team will get back to you almost immediately. That's one of the things I love about them, is they're extremely responsive. And like Tracie said, in this tough seller's market, when you've got to make offers on a property, you know, day one or day two, or you lose it, it's crucial to have a very responsive lender that can get you, you know, pre-approvals or other documentation, or answer phone calls from listing agents or whatever to talk through your financing options. It's a competitive advantage for your buyer's agent, and that's one of the things I love about working with Savvy Mortgage. So Tracie, thank you so much. I see some people are using the clap hands feature, so they're giving you jazz hands, and we look forward to having you back on maybe in a month or two, and doing this again with a larger group or a different group.
Yeah, sounds great. Thanks for having me, guys. If you need me, don't hesitate to call me.
Thanks everybody for your participation. We'll see you next week. And don't forget, we have commercial lending next week, so you're all welcome to join, and please invite anyone else who might be interested.